Welcome back to Premium Option, the channel designed to help you learn and profit from the stock market and options trading. So today we're going to do a very quick short tutorial and guide to options trading. Now I know a lot of you that are watching my channel or just watching this video are wondering what options trading is and you want to learn how to get started in it. And it seems a little daunting and a little confusing, so I wanted to make a very short, very simple video of a 101 guide of options trading. Now I'm going to make a more in-depth video in the future, but this is just something very quick, very short for you guys to watch, just so you get a basic understanding of it, and then you can go out and apply what you've learned in this video and continue your education in the future. So if you guys like the content that I'm producing or you just like the channel, please make sure to subscribe and also comment down below. It extremely helps out the channel and we really appreciate that. And on top of that, we have a completely free Discord that you guys can join with the link in the description down below. It's completely free for you guys. We have everything from market news, market updates, things like resources and questions for you guys to help learn and profit in the stock market. We're growing very slowly, but if you guys want to join, link is in the description, completely free. Okay, so with all of that out of the way, let's actually hop into the iPad as you can see here, and we're going to go over a couple of slides that I think are really important to touch on in order for you guys to understand the basics of options. So the first thing we want to learn about is what is an option, like what actually is an options contract or options trading. So the best way to kind of diversify it or split it up is on the left side, we have you just buying a share of a stock or a fractional share of a stock. When you're buying a stock, you are then owning a portion of that company because you now own part of their stock. And as you can see down here, as time and price increase, well, as price increases and time as well, you get more value out of your stock, depending on if the price increases in that stock. So if you bought Apple when it was $100 and now it's currently sitting at, let's say, like 140, 150, your value would have gone up by 40, 50%. Now you can do the same thing with an options contract. Now, the big difference is when you're buying a stock, you own it. There's really no if, ands, or but. You own that stock no matter what. Now, a contract gives you the right to buy a stock. Now, at the end of the expiration, you don't have to buy it. So you can either just let your contract expire worthless, or you can buy at a certain price. Now, one contract comes in bundles of 100 shares. So there's really no fractional options trading. You do have to buy at 100 shares per contract. Now there's also an expiration, whereas if you bought a stock, you can hold it forever. You can hold it until you die. But with options, there is an expiration. Sometimes they come within a few days or a few years, but typically there is a certain set point at which that contract is going to expire. Now, we have a little graph down here for you guys to understand. So let's say you bought Apple at $90, or Apple is currently trading at $90, and you bought your options contract at $100, and you thought that by the expiration, this share price of Apple would go above 100 and you would pocket the difference. But by expiration, it does not go above 97. You would lose all of the money that you put into the trade, and that's it. Now, why would you do that? Because typically options are a lot cheaper. Now, if you want to own one share of Apple, you're going to need the entire $100 and whatever dollars it is. But for an options contract, depending on what expiration and what strike price you're doing, it can be a lot cheaper and a lot more beneficial for you to do an options trade. So let's actually talk about the two types of options. So as we can see here, there are buyers and sellers, and then you can do calls and puts. A buyer someone buying a call is bullish on the stock. It's basically like owning the stock. You are buying Apple at 100 and your strike price is above that. You're hoping Apple goes up in price. Now, if you're selling a call, you're hoping that the stock will drop because you're trying to collect some money as a seller. A seller is writing a contract to a buyer and they are selling that contract to the buyer. So think of it as just a contract, and the buyer and the seller are giving each other a contract. The buyer is paying for that opportunity as to what the buyer is selling. So as a seller, you're getting paid. As a buyer, you are paying. Now, there are also puts. If you are buying a put, you are paying for that contract and you think that the stock is going to go down. But if you are selling a put, you want the stock to go up and you are getting paid to give out that contract. So let's touch a little bit more on calls and puts, and then we'll touch a little more on buyers and sellers. So calls give you the right to buy a stock at a certain price, which people call strike. So there's the share price, which is what the market determines what it's at. So if we're talking about Apple, let's say it's at $100 hypothetically, and then your strike price can be anywhere below, at, or above that share price. And that needs to be within a certain time period, which we call the expiration, because in options trading, there's always an expiration. If you're just buying your stock, you can hold it forever. But in options trading, there's a set time as to when that contract will expire. Now, for a put, it gives you the right to sell a stock. You don't have to sell it because you wouldn't want to sell a stock if it's above where you bought, because then you would lose money. And on the flip side, the same thing for a call. You wouldn't want to buy stocks that are below because then you would lose money. So that's the nice thing with options. It literally gives you the option to buy or sell stocks. And again, it has the same thing. You're doing it at a certain strike price and at a certain expiration. Now, when we're talking about buyers and sellers, buyers can only buy puts and calls. Now, buyers are considered high risk, but they are also considered high reward. Now, a good example of this is when they talk about high risk. If you buy a call, if you think a stock is going to be bullish and it turns out it doesn't rise as much as you want, or it doesn't rise at all, you're going to lose 100% of the investment that you put up. That doesn't mean you're going to lose 100% of your money. It's just 100% of the money that you put up to get into that possibility. Now, it's also high reward because hypothetically, a stock can rise to, there's no cap. Now, we know that there is a theoretical point to which it actually will, because stocks don't always go up and they don't just go to the moon, literally. So technically, yes, it's an infinite gain, but at the same time, not really. Now, a really important thing to remember is that buyers are paying. They pay premium, and that's called a debit. And they can sell to close at any time. So if you buy a call and the expiration is a year from now, but you want to close it out at 3 months, you can do that at any point. Now, for sellers sell calls and puts. It's considered low risk, but also low reward, because the only profit you're making is the money that you're getting from the buyer. You're getting the premium. So if you're selling the contract, the buyer pays you the premium, and that's the only profit you can make. But at the same time, your risk is limited as well. So it's really dependent on how you want to trade, or whatever strategy or whatever type of a trader you are. And again, you can buy to close at any time as well. So there are some really important terms that you do need to know. There's a ton of different things you need to know, but these are probably the most important in order for you to build a strong foundation. So premium. Premium is the amount the buyer pays the seller. Again, remember, if you're buying a contract, you need to pay for it. If you are selling, or what other people might say is writing a contract, you are collecting money for it, because you're giving a good or something someone wants to another person. So they will buy that off of you. The strike price is an agreed price to buy or sell a stock at. So the share price, let's say Apple hypothetically is $100, but you're trying to buy the call at $110. So that is the strike price. The strike price can be at anything, above, below, or right at the share price. And the expiration is the final date before the contract ends. So let's say that you bought a call at $100. Now, again, this might go over your head because you're brand new, but let's say you bought a call at $100 and the share price never reached it. At expiration, So you're not obligated to buy these shares at a lower price because you're going to lose money anyways. So you might as well just let them expire worthless. But if they are above your $100, then what you can do is you can close your position and then you can make money from that. And again, when they're talking about contracts or people are talking about contracts, one contract is equal to 100 shares. So why would you want to trade options? What's the goal of options? Why not just buy an index fund or Apple or Amazon or Google and just hold it forever? Well, there's three really big reasons. There's a lot more to that, but these are probably the biggest ones. The first one is speculation. If you're speculating on a stock or a certain market and you're bullish or bearish about it, short term, long term, medium term, and you can make more money through options trading, then you might want to go the options route, because sometimes with just buying stocks, it's typically a long-term play and it's for long-term investors. And it's hard to make money just buying stocks on the short term, especially when stocks are bearish. Another way is leverage. You have to put up a lot less money in options trading, but you can make way more money. So that's the nice thing of options trading, because if you want to own 100 shares of, let's say, Amazon, you're going to need hundreds of thousands of dollars. But with options trading, you can buy contracts or options calls or puts on Amazon for a fraction of the price and still make the same amount of gains that you would if you were to own 100 shares, depending on how you decide to play it out. So options trading gives you a lot of leverage, which is extremely nice because a lot of people can get into it that don't need hundreds of thousands of dollars. And another thing is hedging. So let's say you're extremely bullish on a stock and you think it's going to go up long term, but in the short term, they're facing some bad news or things are not going their way. Well, you want to make money on the downside as well so you can protect your position, and that way you can lower your cost basis or make money in a downturn or whatever. You just want to hedge your position short term, but long term, you think it's going to go up. That's another way that options can really benefit you. Now, again, there's so many other things that we can go into, like short puts, strategies, profit loss percentages, the Greeks, covered calls, leaps, taxes. There's so much to go into, but that's not for this video. This is just a 101 video that's going to be very quick and easy. So if you guys enjoyed this video, I just wanted to keep it short, but I would really appreciate if you guys could subscribe to the channel. Follow us for more videos, because obviously we have a lot more to cover. And again, if you do want to join the Discord, completely free for you guys. Link is in the description down below, and I'll see you guys in the next video. Peace.